Most digital stocks had a forgettable 2022 as rising cost of capital hit valuations and demand slowdown crippled margins. Globally, Nasdaq index has lost around 29% so far in 2022, with Fangman stocks down up to 66%. Back home in India, Paytm, Policybazaar, Zomato, and Nykaa have been the worst hit, falling up to 60% so far this year. While the Nifty IT index has slipped 25%, the Nifty 50 index has moved up around 6.5% during this period. Independent market analyst Ambarish Baliga says new age stocks have crumbled as secondary and private markets value a company differently.
That's because we secondary market investors normally look for parameters very different than the PE investors. We need to see cash flows, which unfortunately most of them were not generating. And profitability was not there in the dictionary of some of the promoters, especially Paytm. The initial euphoria driven by hype and demand supply mismatch, that's because everyone wanted to have a pie of the new age stocks about which they've been hearing for long as big wealth creators, multi-baggers for the PE investors. But finally, when you get down to brass tacks, these stocks had to be re-evaluated. Now, we can't weigh all of them in the same basket. Nykaa came with the positioning that it's the only profitable company among the new age stocks. But finally, market saw through it that profitability continues to be low despite rising top line. Paytm, anyways, was too expensive, and they were hoping to cash in on the brand recall. So it managed to scrape through the IPO, but even at 25% of the IPO price, it's not considered as an investment pick by most analysts.
Analysts believe buyback announcements by Paytm and bonus issue by Nykaa were done to support their stock prices, which have plunged around 80% each from their issue prices. Against this backdrop, analysts suggest investors bet on those companies in 2023 that have strong management.
Because when it comes to new and niche market, we bet on the person or the management who is managing and taking decision for the companies when it comes to the new area. So it's very important to understand the growth drivers and how the management would be taking decision to take advantage from it in terms of business.
From a market performance perspective, small case manager Kislay Upadhyay fears valuations may play a spoilsport for some stocks.
Let's look at a listed food service company, for example, operating at negative returns on capital. It posted its second highest ever loss of 1,200 crores last fiscal. Even after severe correction, it is valued at 55,000 crores of market cap. Now, this means it needs an annual profit of 2,000 to 3,000 crores for just the current valuations to be justified, assuming that it needs no more capital from now and turns profitable today. There is a listed cosmetic fashion e-commerce company that is slightly profitable, but even here, the valuations don't make sense. At 50,000 crores of market cap, its profit needs to be 50 times more than what it is for the current valuation to be merely justified.
From a one-year perspective, ICICI Securities has a buy rating on delivery with a target price of 460 rupees. JM Financial has a buy rating on PB Fintech, Cartrade and Zomato with target prices of 910 rupees, 760 rupees and 130 rupees respectively. HDFC Securities has a sell rating on Nykaa with a target price of 800 rupees. Independently, Kislay Upadhyay of Fidel Folio Investments is bullish on Easy Trip Planners, while Ambarish Baliga likes Delivery and Policybazaar. Baliga, however, sees another 15 to 20% downside in Paytm in 2023. As regards today, domestic wholesale inflation data and the outcome of the US Federal Reserve's two-day monetary policy meeting will be on investors' radar.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.